Hello and welcome. If you've ever looked at a long-term chart of the stock market, you'll notice it doesn't look like a straight line. It looks more like a roller coaster, a series of thrilling climbs, terrifying drops, and sometimes frustrating plateaus. But this isn't random chaos. This is the natural rhythm of the market, a predictable pattern of psychological and economic phases known as market cycles. Understanding that these cycles exist and that they are a normal, inevitable part of investing is probably the most powerful piece of knowledge you can have as an investor. It's the difference between panicking during a crash and seeing it as a natural, even necessary, part of the journey. In this video, we're going to map out this roller coaster. We'll break down the 4 key phases of a market cycle, explain the psychology that drives each one, and most importantly, give you a simple, disciplined strategy to not just survive the ride, but to thrive through it. So, let's get ready to learn how to ride the waves. While every cycle is unique in its own way, they all tend to follow a similar pattern, which we can break down into 4 main phases. It helps to think of them as the 4 seasons of the financial world. First, we have Phase 1, accumulation, which you can think of as the silent spring. This phase happens right after a bear market has finally hit its bottom. The overall mood is pessimistic, full of despair and exhaustion. The financial news is overwhelmingly negative. The average retail investor, often called the dumb money, has likely sold everything in a panic and sworn off stocks forever. But beneath the surface, something else is happening. The smart money, the professional investors, the value hunters is quietly accumulating shares at bargain prices. They see the long-term value that others are too fearful to recognize. This is the spring, where new growth is seated in silence. The market begins to stabilize and form a base, even though it seems like no one is noticing. Next up is Phase 2, the markup or the bull market summer. This is the phase everyone loves. Confidence starts to return, economic data begins to improve, and a new, exciting narrative of growth and opportunity takes hold. Prices begin a sustained upward trend, climbing the proverbial wall of worry. More and more investors, seeing their friends and neighbors make money, get a serious case of FOMO, fear of missing out, and jump back into the market. This is the summer of optimism and greed. The rally broadens, affecting more and more stocks, and it feels like the good times will never end. This is where the most money is made, but it's also when risk is silently building up in the background. That brings us to Phase 3, distribution, the cautious autumn. The bull market is reaching its peak. The mood shifts from pure greed to a mix of uncertainty and skepticism. The smart money that bought shares during the accumulation phase now begins to quietly distribute them, selling their shares to the latecomers who are still piling in, driven by euphoria. The market becomes volatile, swinging wildly up and down. It stops making new highs and starts moving sideways in a choppy pattern. The financial news is full of phrases like toppy and overvalued. This is autumn, a time of transition where the wise are harvesting their profits, preparing for what's next. Finally, we arrive at Phase 4, the markdown, or the bear market winter. This is the phase everyone fears. A catalyst, whether it's an economic shock, a geopolitical event, or simply the fact that valuations have become unsustainable, triggers a reversal. The first sharp drop is often dismissed by the crowd as just a healthy correction. But as prices continue to fall, optimism quickly turns to anxiety, then to fear, and finally to outright capitulation. Panic selling sets in as investors rush for the exits, locking in their losses. The winter is harsh, cold, and feels like it will last forever. But it has also a necessary cleansing that resets valuations and sets the stage for the next accumulation phase to begin. The cycle is complete, ready to start anew. Now, the market cycle itself isn't what causes most investors to fail. It's their own emotional reaction to it. The cycle is like a giant machine for transferring wealth from the emotional and impulsive to the disciplined and patient. Let's look at the typical emotional journey of an investor through these phases. At the bottom of the cycle, during accumulation, what do most people feel? Fear and despair. Their instinct is to sell everything to avoid any more pain. This is exactly the wrong thing to do. Then, during the rise, the markup phase, emotions shift from hope to optimism and finally to outright greed. The instinct now is to buy more and more, often at higher and higher prices, chasing the momentum. At the top, During the distribution phase, people feel complacency and even denial. The market has been good for so long, the instinct is to just hold on, believing that this time is different and the party will never stop. And finally, during the fall, the markdown phase, emotions move from anxiety to fear, and then to complete capitulation or panic selling. The instinct is to sell at the worst possible time, often near the bottom. Do you see this destructive pattern? The average investor buys high out of greed and sells low out of fear. They are constantly doing the exact opposite of what they should be doing. They are always chasing last season's weather instead of preparing for the next one. So, how do you break this self-destructive cycle? The secret isn't to try and time the market perfectly. Nobody can do that consistently. Instead, you build a system that works in every season, regardless of the market weather. Here are 3 simple strategies for your anti-cycle survival kit. First, adopt a farmer's mindset, not a hunter's. A hunter is always chasing prey, looking for the next hot stock or hot trend. A farmer, on the other hand, plants seeds and patiently waits for the seasons to do their work. Your job is to be a farmer, not to predict the weather. In investing, this means practicing dollar cost averaging, or DCA, by investing a fixed amount of money on a regular schedule. Say, every month you automatically buy more shares when prices are low during the market's winter, and you buy fewer shares when prices are high during the market's summer. You're harnessing the power of the cycle instead of fighting against it. Strategy number 2 is to have a written plan and a clear asset allocation. Your investment plan is your compass in a storm. It should be a written document that clearly states your goals and your strategy. A key part of this plan is your target asset allocation. For example, maybe you decide on a mix of 70% stocks and 30% bonds. Just as important is your commitment to rebalance. Rebalancing means periodically selling some of what has done well and buying more of what has done poorly to get back to your target allocation. Rebalancing is the ultimate anti-cyclical act. It forces you to be greedy when others are fearful by buying stocks in a bear market, and it forces you to be fearful when others are greedy by selling stocks in a bull market. It automates rational behavior. And the third strategy, tune out the noise. The financial media is paid to make you feel emotion. That's what gets clicks and views. Their headlines are always loudest at the peaks and the troughs of the market, which is precisely when you should be doing the opposite of what the panicked or euphoric crowd is doing. Stop checking your portfolio every day. It's just going to drive you crazy. Focus on the long-term story and your long-term plan, not the daily drama. Here's the ultimate truth you need to remember. Winter always turns to spring. Since 1928, the S&P 500 has experienced a bear market that has a drop of 20% or more on average every 5 to 6 years. And every single one of them, without exception, has been followed by a new bull market and a new all-time high. The cycle always turns. So, to quickly recap, the market moves through 4 predictable phases: accumulation, markup, distribution, and markdown, all driven by collective investor psychology. The trap is our emotional instinct to buy at the top out of greed and sell at the bottom out of fear. And the solution is to use simple, powerful tools like dollar cost averaging, maintaining a disciplined asset allocation with rebalancing, and sticking to a written plan to automate rational behavior. You cannot control the market, but you can absolutely control your process. By understanding and respecting the market seasons, you transform volatility from a threat into an opportunity. You stop being a passenger on the roller coaster and become the engineer. Stay disciplined, stay invested, and let the cycles work for you. Thanks so much for watching. If you found this helpful, please hit that like button and subscribe for more content. See you next time.